So wait, let's see. We got the S&P, we got the Dow, we got the NASDAQ. Oh dear, everything's going down. And we got the Russell. See, I thought it was just me, but I was not really inspired by Trump's little cabinet meeting there. And I don't want to get into, look, I'm a liberal. I don't like Trump. I think his policies are bad. So I don't think that really means I can't talk about him, though. It's like I understand people are Republicans. You might like Trump, you might like his policies, but I'm telling you that they are a huge economic factor we have to pay attention to. They are. They're a huge economic factor we do have to pay attention to. What he's talking, I mean, I'm just trying to, it's like they say, if you can't say something nice, don't say anything at all. But you can't not say anything at all. You got to discuss these things, especially if we're going to be talking about intelligently investing in the markets. So this morning, I was talking about how cutting Medicare, which is this cartoon, got two eyeballs, or two, what do you call this? Not called an eyeball, iris, two, whatever. Two peeping holes. Anyway, that's what happens when you ask AI to make a picture and you don't feel like correcting it. I was just like, yeah, whatever, close enough. But they're cutting $2 trillion out of Medicaid and some other programs, but the big chunk of it is out of Medicaid, in order to pay for $4.5 trillion in tax cuts because, ooh, they worked so well last time. I mean, this is exactly how we started in 2017 with a gigantic unpaid for tax cut program. And then we ran into a crisis like bird flu, although at the time it was COVID, but this one will be bird flu. Not to mention, if an exploding war in Ukraine can happen anytime now too. But so we had after we showered these tax cuts, we then had an unplanned crisis that cost us another $8 trillion, $10 trillion, and we ended up doubling the size of the debt from 18 trillion to 36 trillion. Now it is 36 trillion. We're already running a $2 trillion deficit, and at no surprise to anybody who's paying attention, let's do $4 trillion in additional tax cuts. And it's the same tax cuts that 90%, it's the same tax cut system that 90% of the money went to the top 10% people. And of course, 80% of it went to the top 1%, people like Trump. This is not good for the country. There's no benefit. Not only is it not good, not only is it no benefit for the country, but those of you who are in the top 10%, but not in the top 1%, are getting completely screwed over because the people in the top 1% have infinity money. And that means no, you don't get to buy the beachfront property. It means no, it means no, gold is going up in price. Anything you want is going up in price. Concert tickets going up in price. If you like to buy baseball teams, they're going up in price because the top 1% are just buying everything. They buy 20 cars, they buy 4 houses, 10 houses, 12 houses, whatever whatever the number is, it doesn't matter. There are people like Trump who have 20 acres of beachfront property in Palm Beach, and therefore 20 other people who would have had property in Palm Beach don't get to have it. And I'm not talking about poor people. I'm mean 20 rich people are getting shoved out of the neighborhood. Not only that, well, I mean, in Trump's case, he's closed the roads. He makes it. I live near him. He closed the roads. He made it a nightmare. It's so annoying. It's like when Bill Clinton used to come to New York, except Trump's always there. He doesn't even go to the White House. He's always in the frickin' Mar-a-Lago. So there's, you know, the roads are closed. There's security people. There's all kinds of crap going on all the time. Anyway, but you know, forgetting the impact on the not as rich as he is people, but the impact on the impact on the people who we're taking the money away from. Medicaid is something 93 million people use. And when you look at these numbers, these are insane numbers. When Medicaid finances 40% of all the births in the United States, but it's 65% of births to Black mothers, 60% of births to Latin Americans, 67% to Native Americans, 77% of births to mothers under the age of 19. These are all the people we are going to screw over. And I'm sure somebody's saying, well, they shouldn't have babies. But even if you want to say that you want the, so I mean, what are we really saying here? It's like you can reproduce if you're white, and if you're not white, you know, you're thrown to the wolves. Good luck. We already have, because of this attitude that we have, because of the attitude that we have in this country, that this is even slightly okay, that we could look at these numbers and not be ashamed of ourselves. We have the highest maternal mortality rate in the world by a mile. We're 100% more than the second worst country. And the saying goes, oh, I thought I had one for, oh, I didn't have the other chart. Why didn't I have that chart? Anyway, and oh, here's the infant mortality. We're not the worst in the world. We're only the fourth worst in the world in infant mortality. So more babies die at birth in America than almost any other civilized places. The only places beating us, and not by much, is Hungary, Poland, and Slovakia. Those are the only places where more babies die where more babies die on their birth on the day they're born than we are, and insane amounts like 5.8. So again, we're double what Scandinavia does. And why is it? Well, it's not just the lack of universal health care. It's that by the time the mother gets to the hospital having the baby, it's too late. You already haven't diagnosed a problem. They already had things that were wrong that nobody cared about while she was pregnant, and then she just shows up at the hospital having a baby with no proper prenatal care because they can't afford it. And how is that okay? How is that not the crisis? Trump's sitting here talking about fentanyl at the cabinet meeting, and he says millions of people are dying, which is why I looked it. I wouldn't have looked it up if he didn't make such an outrageous statement. But he said millions of people are dying of fentanyl, and I'm like, I just can't see how that could be true. Millions of people means 1 out of we only have 300 million people in the country, so millions means like 1 out of 100. Millions means you should absolutely know people who died of fentanyl. And that doesn't make sense. So millions of people did die of COVID, or actually 1.1 million people died of COVID, and everybody knows somebody who died of COVID. So that gives you an idea that if it was the same amount of people dying of fentanyl, then you would absolutely know people who died of fentanyl. Anyway, so I looked it up, and it was 57,000 or whatever the number was. It was certainly not. I got to sign in again. I always forget this part. WP. I don't know why this computer always signs me. I guess probably because I don't use it for a certain amount of time. Anyway. So, I don't want to be anti-Trump, but I just disagree with every single thing he's doing. I'm anti-Trump policies, let's say. But yeah, so because so I'm not anti-Trump, but because he told such an outrageous lie, I looked it up, and it turns out that it was 57,997 people in the last measured thing that they had, which was September 23 to August 24. 57,000, not millions, 57,000. And does the President of the United States have an obligation to tell the truth when he's talking, to give accurate information to the American people? I guess not. I mean, he obviously he doesn't think so. You know, it's not like he said hundreds of thousands. He said millions, and it's not even close. It's not even a number that a rational human being would mistake. You know, if he, if he heard the actual, if he cared enough to actually get a report or look at a report or talk to somebody who knew what they were talking about, it's not even in the ballpark of something you would say after you heard that number, if you in any way, shape, or form cared about the people you were talking to, and if you felt some obligation to be honest with them. That's what bothers me. That's where it comes down from the policy to the guy, because that's the nature of the guy, and that's what bothers me about him. But anyway, so taking away Medicaid is insane. 90 million people are on it. 70% of minority births are using Medicaid, and it should be more, not less. We should have better systems, not worse. And also disabled people almost entirely compare. Oh, what is the word? Are depend, not cancer. Weird. Couldn't get the word depend out of my head. So disabled people almost entirely depend on it, unless you're lucky enough to be a disabled person from a wealthy family. I mean, what do you think happens to somebody who becomes disabled? It could happen to anybody. So it's a bad bet in a lottery. Highly unlikely, but if you become disabled, the odds are very much against you. You know, if you just for whatever reason end up in a wheelchair, you've got to have special things done to your house just so you can get in and out of your house and around your house. You probably have to have special stuff in the bed. You have to have like rails and things in the bathroom and in the toilet and on the shower so you can get in and out. You certainly probably need some extra medical care than most people do. You might need a specially adapted car, things like that. These are not cheap things, but you just had bad luck. And as a society, we're supposed to help people who have bad luck. We're supposed to take care of downtrodden things. It's in the freaking Bible. It's in all the Bibles. It's not in one Bible. It's not just the Christian Bible that tells you that you're supposed to help people who are in need. It's all the Bibles. They all say this. It's amazing that I have to even have a conversation that says we should take care of people who are disabled because it's not really their fault and they need assistance. I mean, isn't it basic? Am I crazy? Tell me. I mean, feel free to tell me. I don't understand. I don't understand how we live in a country where this has to be a conversation. Should we or should we not help the handicapped? It's not freaking Sparta. So there's that. So Medicaid is there for people who need the help and can't afford the help in the world's most expensive medical system. And the same thing, I was going to make this point about the people giving birth. You can say, well, don't have babies. Okay, well, fine. So have programs that says that helps them not have babies. Have sex education in the schools. Hand out condoms. But oh no, You know, you saw them go ballistic about some program that gave condoms to people. It wasn't 50 million, it was $50,000 that gave condoms to somebody where it actually made sense to like hand out the condoms. But, you know, like AIDS prevention-y kind of things. And this is what they don't get. Because if you don't spend $1 on the condom, then people have $25,000, $30,000 babies. That's penny wise and pound foolish. And it's the same thing with all these things with prevention. If you don't provide prenatal care to poor women, then they just go to the emergency room 9 months later and have a baby. And if there's something wrong that could have been fixed, you're wasting money. Ignoring something is not curing it. It's ignoring it. It's still there. The disease is still there. The problems are still there. And then what do? Then you end up having babies. And again, we're talking about mortality. You're not talking about, you know, delivery problems and issues and things that leave the woman crippled and things that leave the baby handicapped her in some way all because care wasn't properly given earlier on. Those people, they're not dead. They're now the exact people who end up on Medicaid, who then in turn cost a fortune through the system because we didn't want to make sure the mother was having proper nutrition, because we didn't check her blood levels a few times during her pregnancy to make sure things were good. We didn't do an ultrasound. These are not expensive things, but they prevent things that could be terribly, terribly wrong. So then what happens? So then we're doing all of our care in the emergency room. We're filling up the emergency rooms with things that shouldn't be there in the first place. The staff is stretched out. The hospital's supplies are stretched out, and they still can't afford to pay. We didn't make them afford. They aren't now able to afford to pay because we sent them to the emergency room instead of a proper clinic. No, all we've done is taken reasonable preventive care and turned it into catastrophic expensive care. And the government's now saying with the Medicaid, they're like, oh no, I'm not paying for that. So brilliantly, they've saved money, but have they actually saved money? No. The care still has to be given unless you want to change the law and shoot people who come into the emergency room. The care still has to be given. And then it becomes unpaid for care. Then it becomes an insurance loss or a hospital loss or whatever it is. It's a loss that gets passed on to you and you end up paying for it anyway. But now you didn't pay for it through Medicaid. Now Medicaid got cut. You're paying through it through your local hospital and your insurance and all the extra charges that pile up, and the billionaires got their tax cuts. So the money came out of your pocket at the local level, at your insurance level, and it went to pay, and all that money's taken out of your pockets. It didn't used to be taken out of your pockets in order to pay for the tax cut. And you should all be outraged. Everybody should be outraged by this. And they just voted for this. The House of Representatives just voted for this bill. It passed. And it's going to go to the Senate and it'll pass there too. Oh, and we didn't even talk about the fact that Medicaid pays for 62.5% of nursing home costs. So when you're, you know, when your mother or grandmother or whatever comes back to the house to live because they can't afford the nursing homes, that'll be extra costs that you're paying too to make sure billionaires have tax cuts. Does nothing for you. There's no benefit at all for the average person at all. And it's a complete catastrophe for the bottom 90%. They don't have this money. They can't afford more insurance. They can't afford to take care of their parents now suddenly. It is absolutely insane. So we got that going for us. But that's not what this webinar is about. What was this webinar about? Oh, hedging. Hedging is important. Let's talk about hedging. So we did our portfolio reviews last week. You were here. We were talking about it last week. And There it is. So we're doing our portfolio reviews, and the first one we did was a short-term portfolio review. This was Tuesday last week, which was what day? The 19th, right? Was it? That doesn't sound right. It was the 18th. Aha. So this was the morning of Tuesday, the 18th. And we were up here. We were like at the all-time highs. Oh no, it's Dow Chemical. That's not even close. All right, sorry. Futures. I'm like, there's a Dow. All right, so this was Tuesday, the 18th. Okay, right. Yeah, it makes more sense. All right, so we were sort of like in this nice toppy pattern. Everything was lovely, blah, 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 blah. All right. So what did and it was the morning. And so what did I say Tuesday morning? I said, well, what did I say overall? That was total of our portfolios. You don't get opportunities. You need to be prepared, blah, 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 blah. The second hardest thing, that's what I wanted. So the second hardest thing to teach is when to let go of these positions when they've run their course. And we talked about that. And I said there's a great deal of uncertainty at the moment. The above chart gives us an idea of who's been winning and who's been losing. We still have another 40% left to go, but 40% of earnings left to go. But we've been very happy with our current trading plan. Okay, so we have this short-term portfolio, and what we did with the portfolio, it doesn't matter. DHI, we moved to long-term portfolio. Trox, what we did a little roll. CPER, the copper, we moved around. Skechers, we got more aggressive on Skechers. Here we go, SQQQ. So what do we do with SQQQ? We rolled the $30 calls to the short 30s to the short 40s and increased our protection. And so at the time we were at, that's not SQQQ. At the time we were at 26, okay? And SQQQ is now at 30.40, okay? And it topped out at 31. Well, that's not good. It's going right back up. All right, so that's where SQQQ is. And then we look at TZA. And I said, I want to buy back the short January 25 calls because they were down to 500 bucks. It wasn't because I think we're going to hit 25. It's that any move up in TZA, because we're at 12. I didn't think TZA was going to get to 25. It's just that by buying these back, the short January 25s for 37.5, right? By buying them back, we allow ourselves to have a room to sell more. So these are 2026 25s. I'm sure if TZA pops, I can sell something shorter term that'll make money faster. And we already made $150,000, so we lock it in. So we're locking in that gain and taking it off the table. We can only make 37,000 more in the next 12 months. So that's 4,000 a month. So even if it makes a spectacular move in our favor, maybe we'll make $8,000. So I'm only risking $8,000, but I'm allowing ourselves an opening to be able to sell many, many, many more short calls. So those are the only two changes we made really to the portfolio, and it was at 709. All right, and now we'll check in and see where we are. I'm sure I got to refresh this. All right, so now we're at, whoa, 949. Holy shit. So we made $240,000, and it's because we have no negative now. Well, these short calls at 45s, they don't count. They're never going to be anything. We actually left these on because I'm not paying $14,000 to take down a $45 call. We're never going to hit it, so out of principle, I'm not going to buy it back. We have these short April calls at 12, and we're over the line on those now. We're down 12,000 bucks, but we made another $180,000 on our 45s. And also on SQQQ, we made 60-something thousand dollars. So there's most of the money right there. But what did we do? We raised the ceiling because we had the short 30s, and now we have the short 40s instead. So now we have a lot more room to run, and the short 40s did not gain as much money as they would have. So now we have the 2027 short 40s against these, and we still and the long 20s. We still have plenty of room to sell short-term calls also in this group. But I'm not, and I did look. I looked carefully yesterday. I don't have the confidence to sell short calls against either one of these things. I don't think we're done going down. I think we may be having a huge correction. And so, yeah, we made $240,000, but we have 1.7 million. Oh, look at these two. We made money there too. We have $1.7 million worth of hedges. So we only made not even 20% of what our hedging capacity is. And that makes sense because we only fell 3%. And so, our hedging is for 20%. So we fell 3 out of 20%, which is 15%. And we made about 15% of what we were supposed to make. Makes perfect sense. That means our hedges are working perfectly. The long-term portfolio does not reflect the adjustment. So I don't think you can't really put much stock in what the long-term portfolio says at the moment. Yeah, so 4 million, but I mean, but anyway, so the bottom line is the long-term portfolio didn't go down very much. Let's see where the long-term portfolio is. There it is. It was 4 million. So it was 4012, and now not with the adjustments, but now as it stands, it's 391. So the short-term portfolio made more money than the long-term portfolio lost. That's perfect, right? Because why? Because we were very aggressively short in the short-term portfolio, and in the long-term portfolio, we sold a ton of premium. We had almost every single position covered in the long-term portfolio, so they got taken down already from the dip. But it's only a 3% dip in the S&P. It's not a gigantic drop. We will lose a lot more money in the long-term portfolio if it keeps dropping, but we're very comfortable that the short-term portfolio is going to protect us for the most part, at least for the first 10%. Now, once we fall 10%, we're going to want to, up our hedges in the short-term portfolio, or cash in our longs, or a little bit of both. And in fact, we did. We took out, we covered almost, if you look at the review, this isn't the review, this is a portfolio. If you look at the review and what we did, I said short puts on track, but why take a risk? Let's close them out. We took out all the short puts. Not that they were doing badly. It's HBI was up 65%, MGM's up 40%, and Valet is up 23%. But why risk a downturn? We can always sell more short puts. So rather than risk it, we took them off the table. And that means we have less to hedge. We have less margin requirement on these things if they go the other way against us. If I'm nervous about the market, why would I have naked short puts? Even if I like the stock, even if I want the stock at the net price, I still don't need the hassle. We can always sell them again. That's the thing. People get too attached to their positions, and they think that they got to keep them. It's like the position doesn't love you. It's not a freaking cat that you took in. It's not like a puppy you picked up on the pavement. If you have any reason whatsoever to think a position might hurt you, get rid of it. So what were the changes we made? So first thing I did is closed all the puts. FL on track, great price. Even uncovering this one seems risky. Okay, given the big drop into the weekend. BFC so deep, we're not worried. ADP was on track. Let's take the money and run on Mo. So what does that mean? Here's Mo. Oh, I see. Because they had a big bump, and we were up 61,000 here and 6,000 here. We were very aggressive, so I could have covered it. But why cover it? We had a spread that we paid 15 minus 7. We paid $8,000 for this spread, and we're netting out $75,000 from our $7,000 beginning. We're up 10 times on this spread. I could cover it, or I could take the freaking $70,000 off the table and not worry about it. Because even if we cover it, it's not going to be good enough. So we didn't, and we cashed it out. And how did Mo do since then? Oh, boy, am I glad we did that, right? Oh, no, that's confusing. No, I take it back. Is that right? No, actually, they apparently they did really well. So we were on the 18th, 14th, 19th. Oh, I'm sorry. No, that was more like Friday, the LTP. I'm sorry. When we did the LTP review, it was actually Friday, so it was on the 21st. So yeah, apparently we could have squeezed a little more out of it. It was Friday the 21st when we did the LTP review. It was at 55. They actually had a big pop after that and went back down. But we didn't know that was going to happen. So basically, we were very happy and took $70,000 off the table on Friday. Because that's what it looked like on Friday. It actually topped out like here and came back down. So they had a great run. Target waiting for earnings, ACAM. We need to take a look at this next week, and we did. We made adjustments on it. We actually bought into it, I think. AMD, brand new but not trouble. Boeing, let's buy back the short 220 calls, and we sell something else next week, which I forgot to do so far. And hopefully it didn't get killed too badly. Let's see, AKAM, how'd they do? Ooh, okay. So ACAM's picking up like I thought. Boeing, how's Boeing doing in this crash? Always want to look and see how people are doing. So Boeing back at rock bottom. So not the best call, because like I said, we made that call on Friday, and Boeing is way down from Friday. It's $8 down. It's not way down, but it's down. We left these guys alone. Coinbase has been up and down since we made that call. Disney, we don't need the December calls. Let's close them. And I even said here, I said, by taking cash off the table and selling short-term calls to cover our longs, we're increasing the effectiveness of our hedges, right? Because it's the same hedges in the STP, and now they have less to cover, so they become more effective. It's another way to increase your hedges is by decreasing what you're protecting. I want less positions, not more, so we're going to kill it, not cover it. GNRC, we'll take advantage and buy back the short calls and see if they bounce. Ooh, that was aggressive. GNRC, how are they holding up? Ooh, yeah, good job. Okay. And that's hugely important information, right? You know, the market is way down and they bounced. Here's gold. Let's sell. Now gold we covered. We had a nice pop and we're not greedy. And we sold 30 May 18 calls. And what happened to gold? went from, I need the hourly. So Friday go was here. It didn't really change much. It went down to here and down to here. So we sold the calls, though. We figured it was going to be, it was going to top out here, and it did so far. You're better off covering than not covering. JP Morgan cashed out the long calls, bought 80 more spreads to cover the rest. Another, a key part of the position was 60 long calls, but 170 is $100 in the money. So what do we want to leave those open for? Let's take the money. And how does JPM end up? JPM. So that was from Friday. So they had a nice little dip. They dropped, not a big deal, 10 bucks, and went back here. But the difference is the long calls that we had on JP Morgan with the 170 calls, those have a delta of 100. They lose dollar for dollar as JP Morgan drops. So they would have dropped $10 times 6 is $60,000. They would have lost 10% of their value. Whereas the 240, 290 spread has a net delta. And what's a net delta mean? This is a really, really important concept. Yeah. JPM. Oh, they don't have a delta. Net change. Who cares about the net change? Delta. There you go. Delta. So, like I said, we had the 170s. See that? And the 170s have a delta of 91. So for every dollar JP Morgan moves, it's going to lose 91 cents. All right. Whereas we replaced it with the 240, 290 spread. So the 240s have a 70 delta, and the 290s have a 48 delta. So that's a net 50, not net 52. What am I talking about? It's 70. A net 22 delta. So, so in other words, the net delta is what the option spread will lose on a move. So it'll lose 22 cents for every dollar that JP Morgan moves. So on a $10 drop, it'll lose $2.20. On the other ones though, they would lose 90 cents out of a dollar, so they'd lose $9 on a $10 drop. It's a big difference. And that's what hedging is all about. It's really the relative changes in the options that you're buying and selling is what really matters in the end. So the 170s, if we're not expecting a lot more upside, the 170s were inefficient to hold. And they were really inefficient to hold. So in other words, the call was that we had run our course and that this was plenty for JP Morgan. After coming up from 200 to 270. And so we had these $600,000 worth of long calls. We still needed to cover, let's find the position, the position's messy. I don't even think that's a whole position. I think we have something, I think we have a bull call spread too. Nope, okay. But we had a bull call spread too. Oh, I see, that's the old bull call spread. So we had these 170 calls. They were $600,000 basically, and we had a bunch of shorts. See, all these are shorts. Short call. These are puts. These in fact have short calls against them, right? So we can't just like cash them out and say, okay, we're super short on JP Morgan. Would have worked out, but we didn't know that. So instead, we trade in this thing, the 170s, for 80, which is only a little bit more of the spreads. But the spreads Oh, I didn't do the price of it. Oh, I did. It's 400,000 off the table. So these spreads, 80 of the $34 spreads. Is that right? 5460 minus 2925 times 80, 200,000 bucks. Yeah, that's right. Okay. So the spreads were $200,000. So we took 400,000 cash off the table, and we still have 80 of these $40 spreads, which is $320,000. So we still have another $320,000 of potential upside in addition to the 400,000 we took off the table. That's the beauty of that kind of trade. So it's idiotic for us to hold on to these spreads, to these calls at $600,000 when we can take 400,000 off the table, move it to something more useful, more productive, and still leave ourselves with $300,000 worth of upside protection against the short calls. And we're still in the short call selling game. And that's how you make these outrageous returns in the long-term portfolio, because we have the ability to make those kind of moves. Here's Lockheed Martin. We rolled the 5. Now, because it was way down here, we rolled the 500s to the 400 calls. So we spent $45 rolling our long calls down $100. We added 5 more. So we'd have more, but then of course, what do? We turn around right away and sell, we sell some short puts. So we got pretty aggressive on Lockheed Martin, and let's see what happened. And of course, obviously it's silly to say that it matters what happened 3 days later, but just to give you an idea of what we're looking at. So that was on Friday the 21st. 21st. That's somewhere around here. So yeah, it did pick up, but then the market crashed. So, but still, it's holding up. It's holding up nicely considering, and that's what you want to see. Today's a bad day. 7% down today. Oh, not 7%. $7 down today. 7.2%. So anyway, but yeah, we made a bottom call on Friday when the chart looked like this. We said that seems like a good bottom. We like the valuation. We think it's all good. So we basically doubled down on our long-term play. We got more aggressive than we were. Here's Lovesac. I said we're up 85% on the short April calls. There's no sense in risking earnings, so let's buy those back. That's interesting. LOVE. So we bought back our short calls. Obviously, the market tanked, but Lovesac did well. Yes. Very sound reasoning. Did they have the earnings? No, they didn't even have the earnings. So here on Friday, this is 21st, yes. So here on Friday, I said that I think this is a bottom and ahead of earnings want to buy it. And even though the market crashed, it's still holding up very nicely. So there are obviously people who agree with me that this was a good idea. Macy's, I said, let's keep an eye on. So let's take a look and see what I was talking about. What are you up to, Macy's? Awful. Well, not terrible. I mean, they were at 1540. Now they're down to $1. So that's a bit disappointing. Was it earnings? No earnings. The earnings were way back here. So just basically down with the market. I like Macy's though. Our February short puts and calls are going worthless for profit. I'm not in a hurry to retarget yet. Let's keep an eye on them. So that's where we are. So we're basically gathering information before we make another play. Merck is new. They just had a good day. I know that for sure. Moderna were disappointing. Micron on track. Nike on target. Nike just got some nice words from somebody. See if that helps him. And again, when when the whole market's going down, we will pay special attention to stocks that hold up like that. So that's pretty good. Look, and this was me Friday saying that I think Nike's going up. Nike super popped. So very good job by Nike. And somebody just said something nice about them. I don't remember who it was. Wall Street analyst thinks Nike stock is going to 115. Aha. Okay, there you go. I knew somebody said something nice. And that's what we thought too. That's why we bought them. ON brand new, Ozark was brand new, Paramount is still annoying. Pfizer was on track, Prudential, Qualcomm, RH has gotten weird. They had a massive pullback. There's no logic in risking the short March 250s with only 3.2% left to gain. Let's buy those back. So those are short calls that we bought back. And the short 2027 420 calls were minus 229 last month, and now they're plus 103. So let's be thrilled to buy those back. So in other words, we had been burned badly on RH. It wasn't good for us that it went up here. We didn't think they had it in them. So we decided to go back. So now we made so much money on the short March calls and the short 2027 calls that we bought them back. I'm curious to know how this is working out. Ooh, and a good decision. Look at that. Oh, man. So what did we do? We bought back the short calls against RH because we felt like we were hitting a good bottom. And despite the terrible market for the last couple of days, we do seem to have hit a nice bottom. So what are we going to do when it gets back to about here? We're going to start covering them up again and make more money. And that's how this stuff works. That's what we do. And SoFi on track. Stellantis just had bad news. I think they had a bad day. Tech is on track. UNH has had a horrible time. But we called this though. I said big dip today. That was before the day ended. As noted in chat, they make $30 billion a year and the oil industry gave Trump. So there's my logic. UNH makes $30 billion a year. All right, and they were saying that they didn't file their Medicaid. In fact, it was Medicaid. They said they didn't file their Medicaid reimbursements properly, that they were somehow gaming the system, blah, blah, blah. And I said to myself, I'm like, okay, well, they make $30 billion a year. The amount of reimbursements they're talking about are not much more than a couple of $1 billion a year for them. And obviously, they're talking about saying that they should have called it one category, but they called it a better category. That doesn't mean it gets totally wiped out. They might get fined, this and that. But still, you're not going to have a very hard time getting to $3 billion. And meanwhile, Trump can be bought for a lot less than $3 billion. So the chances are they're not even going to get a proper fine. So it's time to join the dark side. Okay, when they're sold off like that, we say, okay, well, it's fine. So we bought back our short calls, and we rolled our April puts down to the 300 puts just to shorten the time span where we get our money back, which is working obviously well already. And we're just taking advantage of an opportunity because people just panic out of something. They hear like, oh, the government's checking them out and this and that may be wrong and so on and so forth. But they're holding 450 in a shit market. That means there's some real value here. We sold the 3-something puts. We have the longs. We're going to be in great shape on this trade. You have to ignore the panic and look at the actual numbers. And UPS was new. Valet is still a problem. WAL is brand new. Walgreens, how's Walgreens doing in this mess? So that's a good time to check it out. Whoop. And hold on to your hats for the next part because we're going to check out a lot of things. So here's Walgreens really not going anywhere since then. It's just drifting along, but drifting along when the market is tanking is great. That means this is a good indication that we actually have a floor here. Whirlpool, that's another one worth taking a look at. XYZ was SQ. That's awful. Wow. I said worth watching. I mean, a terrible earnings report. So what are you looking at here? We got WHR. Oh, no, see, flattening along. That means we're probably at a bottom. If the market is tanking and they're not, we're probably at a bottom. Oh, XTZ. XYZ. Ooh. So what's actually going on with these guys? So that was terrible, and they bottomed around here, and they're nudging up a little bit. How's the market doing? Russell's down. The Dow is down. The Nasdaq is down. The S&P is down. Oh, very sad. Only a little though. Nobody's down too much. But still, down is terrible because it means we're not even bouncing, which is what I said. I said we're consolidating for a move lower. Anyhow, so now let's see what we need to do. Anybody got any questions? Cody says, I feel like an idiot for asking, but I don't understand the SQQ shorts and how you use them. I would love it if you could break it down for me since I'm a moron. Okay. All right. I'm not going to do it now, Cody, but please ask in chat, okay? And I'll have Warren do a whole master class explaining the concept of shorting with the SQQs, okay? Because it will take like a good half hour to go through it. TDD dropped recently. TTD? Trade desk. Oh, geez. What do you think of a bull call spread on trade desk? Well, I don't actually know what they look like. Let's take a look. No, see, I got a problem right away. Their prior PE, so their current PE is 92. They project that they're going to have this amazing growth and they're going to go to 70 and they're going to go to 30. So that means they've got to basically triple their profits. All right. So now you're talking execution risk. Hello. These are, these are not my kind of stocks. Well, and you know why? In fact, here's a good example. Look at Amazon. Okay, they make $67 billion a year. They'll make $82 billion next year, and they probably will because that's the way online profits are growing. They're priced at 32 times earnings. I don't have them. But that's a mega cap stock with incredible power, position, so on and so forth, and blah, blah, blah. You are looking at the trade desk. They make not even $1 billion, yet you have to pay $37 billion to own them. Last year, they made $179 million. That was up 3 times from 53 million, but 53 million was down from 138, which was down from 242. So they don't have a history of consistent, fantastic growth. They did increase their their revenues from 1.2 billion to 1.5 billion to 1.9 billion, and now they project 2.8. Now the funny thing about that is though the 1.5 to 1.9 is what 20%, but 20% of 1.9 is not another 0.9. So they're saying that we're going to rapidly accelerate our revenues, and even better, we're going to drop. We were dropping 10% to the bottom line, but now we're going to drop 30% to the bottom line. I don't believe that story. And even if they do all that bullshit, they're still going to be trading at 40 times earnings. Even if they do all the bullshit they say they're going to do, they're trading at 40 times earnings. I got better things to buy for 40 times earnings. So the fact that they fell from 100 plus earnings, they had to be at least 100 times earnings up here. So the fact that they fell from 100 times earnings to 40 times earnings doesn't make me want them more. It makes me question their entire concept of what they're doing. As far as debt goes, they have cash. That's good. They have $1.3 billion. Well, 1.4 debt, 1.9 billion. So they have 1.9 billion in cash. That's going in their favor. But still, 40 times earnings is a lot. I don't think I'd be very comfortable with that kind of number. Now, that being said, if you want to play with trade desk, I would play it down here and take advantage of the volatility. And so I'd be looking at them and say, yeah, I'm gonna drink. So I'd look at them and say, how do they play out below the price they're at now? Are they worth engaging with? So we go TTD. Because I don't, I'm not saying they're going to go out of business. I'm just saying if they don't execute, they're going to go even lower than they are now. But at 72, let's say we consider 50 a good price. So you can sell the $60 calls for $10, $11, right? $10.50, well, it's $10.55, 11, so more like $10.75. So let's say you sold the $60 calls for let's say $11, whatever. That's going to put you in at $49.50 or 49, whatever, 49.50, 49, somewhere in that range. Do I think that's okay? Yeah, sure. So given that, now you kind of have like a free $11 in your pocket, right? So now you say, well, what long do I buy? So rather than going for these idiotic numbers, why don't you say, oh, I think 72.50 is a good place. The 72.50 calls are $22.50, right? So that's all premium. It's $22.50 in premium. So the question is, what can I buy lower that makes sense? And let's say we look at the 55 calls. The 55 calls are $31. So what do we say? 52.50. 52.50 minus 31.00 is net 21.50 on a I'm sorry, it's a 70-55 spread. Is it worth buying the 45s? The 45s are $37. So I'm sorry, what were the other ones? I forgot now. If you expand this calculator, you get like, there you go, 31, right? So should I pay $6 more to roll down to the 50s? No, that doesn't make any sense. I'm sorry, to the 45s. How about the 50s? The 50s are $34. Should I pay $3 more to be at the 50s? That's almost acceptable. But I think the 55s are fine. So the 55, I'm sorry, so the 55s are $31 and the 70s are $23.50. Whoops. Okay, I did something wrong there before. Sorry, the 55s then are 30. It's not 31 even. It's 30.25 to 30.95 is 70. So figure 40. So 30.65. So it's 3065 minus. We said the 70. Oh no, we looked at 72.50s minus 2270 minus 2270 is $7.95, and that's on the 72.50 55 spread. So that's $7.95 for a 17.50 spread. That's not bad, right? So here's the thing: if you spend $7.95 for the spread and you sell the puts for 11, whatever the heck it was, 11.50. So then that'd be minus 11.50. You would get a 355 credit against your $60 short calls and the spread that's 17.50. So that's how I would play it, because all you're doing is saying, geez, all they have to do is hold 77.50 or 72.50. I'm sorry, all they have to do is hold 72.50. They're at 72.50 now. So if they hold 72.50, you're going to get paid. Let me make sure I have the numbers right. You're going to get paid $17.50 per long on a 355 credit. You're going to make $20 per spread if they just hold 70. So why would I take a risk? Why would I go with any higher numbers? Why would I take any gambles on the strikes? Your worst case scenario is you get assigned at $60 minus 355 is 56.45. So your worst case scenario is that you own the stock for 56.45, which is about 20% lower than it is now. So I don't like Trade Desk, but I like that spread on Trade Desk. I think Trade Desk isn't that bad that I wouldn't take that spread. So that's the way I would go with that. So you had said 50, 70 sells some 60 puts. Oh, isn't that funny? I didn't even read that for. Basically, so my answer is yes. Except I said the 50 and the 72.50s. That's the only difference. Because I always want to sell as much premium as I possibly can. What would be a good trade for Amazon or Google or AMD? That's a lot of questions. I'm not going to get into that now. That's a chat question. That's too many things. Larry says, since the spread moves up and down net delta, how can you say we have portfolio protection for the net spread? That's a great question. Okay. So having a hedge in the portfolio is not about immediately getting your money back. It's about if the market goes down and stays down, then the premium will wear out and we'll have our net. Okay, so if you're looking for immediate satisfaction, you're not going to get it, although we did get it because we made $240,000 while the long-term portfolio lost 100. So you can make the money, but you can't count on it because exactly what you're saying, the net delta. We're only going to make 22 cents when it goes in our direction. Okay, but there are other factors because that's not the only spread we have. We then are selling short puts, short calls, and doing other stuff. That's one thing, but that's not even the point. The point is that we need the hedges for if the market goes down and stays down over a prolonged period of time. During that prolonged period of time, the premiums will wear out and the deltas won't matter anymore. But if the market bounces back, then we never needed the hedges in the first place. So the fact that they didn't square up won't matter. The stocks come back. The point of the hedges is to make it so we don't have to sell our stocks. We can hang on to them and say, well, at this point now, if the market stays down this low, then we will get our money back on the hedges. Then we'll use that money to spend money to pay for rolls on the longs and so on and so forth. But yeah, the hedges are only there to mitigate the damage, not to erase them entirely. It just so happened that because we had hedges in the long-term portfolio and we had hedges in the short-term portfolio, that the short-term portfolio made a lot of money. Also, the way we do it with short calls and short puts made us additional amounts of money as well. But if you just look at a straight bull call spread of an SQQ, yeah, you're only going to make 26 cents to the dollar on the upside. But if we stay down and we finish at 30 or 35 or whatever, then all that premium is out the window and all that matters is the actual position of the stock in January of 2027. And that means that what you're saying is that if I have $1 million in stocks now and the market drops 20% and I have $800,000 worth of stocks, and I'm simplifying it obviously, I have $20,000 worth of stocks, but I also pick up $200,000 on my hedges, then I still have $1 million. But the key to that is I have $1 million and the market is 20% lower than it was when I started. I still have $1 million, but the market is still at 800,000. So when I rebuy and rejigger my positions, I will have more bang for the buck going up. And that's where it is. It's such a long-term strategy that you're only looking at the first stage of it. It's a multi-year, multi-move strategy. And of course, the supposition is that we're not expecting the market to have more than like 3 or 4 years of a major downturn. But that's something we look at as time goes by. We may go more to cash. We may end up cashing everything out and counting on the hedges to hold and make the money on the hedges. But the key to the whole thing is don't lose money. Because if the market drops 40%, and you still have 900,000 out of $1 million that you started with, that means it only costs 600,000 to rebuy all the stocks you would have had at $1 million. And so you can now buy 900,000 worth of stocks, which is 150% of the amount of stocks you would have been able to buy before with the same money. It's not relevant that you ended up with net 900,000 because you have net 900,000 and all the companies you wanted to buy are 60% or 40% off. So that 900,000 is fantastic. So it's really a relative game. It's a very it's an Einstein physics sort of thing. It matters as to the position of where you are, where you were, where you're going to be, and which way you're observing it from. But the key is don't lose money. You can always adjust. And in fact, that takes us very nicely into what I was going to talk about next, which is the watch list. And how the hell am I going to find the watch list? That's the flaw in my plan. It did not occur to me. I have to find the watch list. All right. See if this works. PhilStockWorld.com / watch list. Watch list review, PhilStockWorld, 111. Shit. All right, forget it. I'll have to look. Apologies, I don't know where the watch list is. But this is exactly the time we want to use a watch list. Let's see, members only, webinars, portfolio reviews, top trades. Nope, it's not one of those. So it's going to be Phil's posts. And it's going to be post by Phil. If anybody who knows the date, let me know. So let's go there. This takes us to what, February? Let's say number 6. And that's already December. Okay. Now we're into Thanksgiving. Aha! See, I already use that same thing, so I see it. So, what is the purpose of a watch list? The idea is that we pick, in this case, it's probably about 100. We pick 100 different stocks, or it's not a purposeful 100. It's just basically I pick the stocks that I feel are ones we probably want to buy if we get a chance, if they get cheaper. So, oh, you're kidding me. I'm so annoyed. I had meant to replace these charts. See, some of these, this is a self-updating chart. They're not all self-updating. This kind of chart doesn't self-update, and I meant to replace them all, and I forgot. Sorry. Anyway, so who got cheaper since we were looking in November? That's the key. So we look at these kind of charts. So here, Baxter is still cheap. Barclays went boom. Look at that. No. Oh boy, it's tough because things went really well since November. Cheesecake, CIM for some reason has 2 charts, 14. So CIM is still cheap. Cleveland Cliffs. Now, see, they're tariffing things, so this is a good pickup. So Cliffs is a good pickup. Damn, I gotta do all this work still. Crocs is still very cheap. CRISPR is still cheap, but they're not really getting anything done, unfortunately. CVS took off a bit. Disney took off solid since we picked them. We don't know what Dow's doing. EPD, this is annoying. Oh, I'm sorry. I'm gonna do this again next week when I get this thing updated. Here's Ford has been very cheap. I think that's a crazy low price. So Ford's a really good one to get. We do have it in our portfolios already. FF I like to buy when they're cheap. Future Fuels. They're not benefiting at all from the things Trump is doing. It's been very bad for them, but this is where we want to start looking at them. This is a really good price, and we're going to be very excited to get back into this one. FL still very cheap. You know, this is where the watch list is super useful, right? Because all you got to do is look at these charts and say, well, we liked them, so do we still like them? Well, Gilead took off too much. GNRC, cheaper than we were looking at it, so we like that one. Gold is crazy, but we like them. Honeywell, I mean, it went up, went down, so it's in the same place. IBM, well, that's not an updated chart, but whatever. IMAX, doing very well and should continue to do well. They have a very, very strong movie slate coming up. So not on sale, but a good stock. IP also not on sale, good stock. IVZ, we have them already in the portfolio, and they're flat. They're flat to where they were, so still a good price for IVZ. Jack in the Box. Oh, you got the fires, right? You got the rising labor cost and everything else, but meanwhile they kind of flattened out here. So this is where you want to get in. We already have a Jack in the Box in our portfolio, but I definitely like them. Nordstrom's, aren't they getting bought out or something? That's why they flattened here. I think somebody's buying them. Kayla, oh, now see, Kayla took, oh no, I'm sorry, that already happened. Okay. Yeah, I'm sorry. The whole point of the watch list is that it has self-updating portfolios. So you should be able to see where everything is. So they've been drifting and drifting along the bottom, but I think that's fine. Let's see what they've been doing lately. So the fourth quarter earnings, not much. It's not much going on. But these earnings were what? Big beat on EP. Okay, so big earnings beat. But the GAAP earnings were not, so it's weird. So there's something weird going on here we'd have to look into. And the revenue is up nicely. So not perfect, but definitely worth looking at. All right, his KLG is drifting along crazy. KHC also, I think we just added them to something. KMB, I don't know. Coca-Cola, crazy. Wow. We picked them up somewhere. Here's Lebu, the biotech ETF. It's still just flattening along. Levi. Oh wait, that is updated, right? Yeah, that's updated. Here's Levi. I love Levi down here. These are a lot of good stuff. Lean forward. I like the tech a lot. It's like an exoskeleton that helps people from wheelchairs work. But now with Medicaid cuts, and that's what I wrote at the time, with Team Trump, it's very unlikely the government is approving a system designed to help people walk again for Medicare because it costs them money. That's the problem. They can't. They're going around the whole world doing this, but I mean they've got to get it approved by healthcare systems. People can't afford these things. They're like $25,000, $30,000. But you know what? You can get out of your freaking wheelchair and walk around. It's an exoskeleton that just, works around your hips and your legs. So it allows you have a robot assisted thing that goes ring and you go up and you walk and it lasts for like 4 or 5 hours and you can walk around the town. You can go shopping. You can do things. It's amazing. And I figure that some combination of it getting cheaper and countries, and people eventually going, this is something we should be doing for people. We hope it would kick in, but it's tough because, when the country that the product is from doesn't want to support it, it's difficult for them to get it in other countries. Lovesac, very cheap. A lot of import-export issues, but I like them. Las Vegas sands should be picking up in Macau. It seems that China stuff is picking up. That's big for them. So good price here, worth looking at. Medtronic, I always love when they're cheap. They popped up a bit, but they're still good. MGM, another China play. Resorts and Las Vegas numbers are coming up, so I don't know why they're down so much. So we'd have to look at why they're down, but they're worth looking at. Middleby, I always love. MP. This is rare earth metals in the United States, so I don't even understand why would they be this price? They were $21.75, now they're $24, so they're moving up, but I still think they're way too cheap. mRNA, very, very disappointing lately, but I like them long term. Metal Steel, I've always liked them. They popped up nicely. Nike, also we just added to Nike. We just talked about that in the long-term portfolio. I was not happy with them in November. I said they're expensive despite their decline, but when they came down here, we added them to the long-term portfolio. NLY, I love them, and they're starting to pop. They pay a huge dividend. That's what we like about them. OLN, also very good stock, and now that it's down from 40 to 26, unless we can figure out what's exactly, unless we can figure out why they're down like that, this is a good thing to take a look at. Paramount, eventually they'll get bought, maybe, I don't know. It's hard to say. Trump is suing them, so a little, probably not the first thing I'd be adding right now. We do have them already. Here's Pfizer. Can't believe Pfizer is this cheap. That's crazy. Procter & Gamble. I don't know where they are because that's not updated. Rocket Mortgage. I like them, and they're way cheaper. Well, I'm sorry. They were cheap in November, and they've come back up. Because when they were 1060, I was like, are you kidding? Mixed performance, blah, 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 blah. So I think they're improving. RH, as I said, we had that big pullback. And I said that 2024 PE of 161 has been keeping the people away, but ongoing international expansion could justify the multiple next year. And I said that in November, and they're up a bit. I think they were 333 when I said that. And now they're 354 after the pullback. They went all the way up to 450 from 333. Now back here, there's a chance to catch them again. Rio Tinto, I like a lot down here. Skechers, I like too. Just good basic footwear. People always need it. I mean, it's the thing, things that people absolutely need that also wear out are great things to invest in. Schlumberger, you would think there will be many, government contracts and stuff ongoing with these guys. SoFi, I love when they're cheap. They're not cheap now compared to where they were, but I still like them long term. Sony, whoa, Jesus. Well, Sony, we missed the train on that one. They took off. Simon Property Group, another one I like a lot, and also not cheap. SWK is still drifting along pretty cheap, so we like that. Synchrony wasn't Synchrony our stock of the year? I'm pretty sure it is. I think Synchrony is our trade of the year. I don't know what they're doing now. Wait. 64.61. I think they were the trade of the year. 59.63, cheaper. I think that one ended up being our trade of the year, so we still like them, obviously. Not sure what happened. What did happen? A 1% miss. Give me a break. Good God. So I'm pretty sure that still holds up for our trade of the year. AT&T really took off. That's a shame. That was a fantastic one. Here's Target. Target is down in the dumps, but we like them down in the dumps. They'll figure it out. It's, they have to adjust to the tariffs and all the things that are going on and the changing consumer base and how the customers are going. You got to change your mix. And we knew they were going through a struggling time, so we're waiting, but they seem pretty settled out down here. TNDM is still down and inexpensive. Trox is ridiculously cheap. But the problem is, you look at these industrial production reports and everything is slowing down, and that's not good for them. So until things pick up, they are going to stay down there, but they will come back. This is a very, very specialized metal that they make. It's very necessary in all sorts of modern technology, and it's just a question of when they turn it back up. TRVG, I think, popped. Oh, look at them. Yeah, from 167 to $4. I believe we took them off the table. I think we already cashed out of those. TWO is also taken off again. UHS is drifting along where it was. USB, I'm pretty sure, are up. Oh no, they're down 45.78. So there you go. They did get cheaper. 45.78 is down here. All right, so that might be time to take a look at them if we're looking for a bank stock. And here's Valet, our prior year stock of the year. Didn't do that well, actually. They're still hanging out, put down here and pretty cheap. And VTRS, also going nowhere. Verizon, we picked up because they took it. And that's what it is. Verizon took a dip. We jumped in and we added them to our portfolio. And, well, oh, that's not telling the whole story, though, is it? Yeah, and they have since popped. And Walgreens, I still like them. They're going to probably be bottoming out down here. It's been a pretty good solid bottom, right? So somebody's accumulating them at this level, and eventually they'll pick up. And here's Whirlpool. People are freaking out about this, but what a solid appliance company for a long-term play. So I like them down here. Xerox. Oh, the company reported a GAAP loss and included a goodwill impairment charge. So what happened to earnings? And earnings couldn't have been that good, though, if they're still down there. Whoa. Oh, yeah, earnings were some kind of catastrophe, huh? Look at that, minus 31% surprise, minus 140% on the GAAP. Revenues are up a bit, so I don't think it would be impairments again. This was impairments. minus 2,306%. That's pretty bad. What the hell? Is this company going out of business? But keep in mind, that's right, it's a watch list. We didn't add Xerox to our portfolios, but holy cow, is this an opportunity or are they falling apart? Have to check that out. Here's Yeti, another old trade of the year. And this is a good, solid company down at this level. I like them. So that's our watch list. We just went over a lot of companies. So that's our watch list. And in times like this, when the market is throwing a sale, this is the first place we go. That's why we have a watch list, because we've already looked at these companies. We already decided we would love to buy them if they were cheaper. If they weren't, it's not a buy list, it's a watch list. So when they get cheaper, we go back, we check out all of the old premise, what we had, we find out what's happened in the intervening time, and we see if maybe they bring up ring any bells and make us want to buy them. Okay. If there's no more questions, I'm pretty sure I went over what I wanted to go over at the moment. How's the market looking? Oh, getting a little bit of a bounce back, so not so terrible today, but not good. We needed to start making some improvements, and we're not making them, and it's a week now. Well, it's not a week, it's 3 days, but after 3 days from a huge crash, you need to be bouncing somewhat. And we're not doing that. We're languishing. So this is not so far an environment where I want to jump in and start buying things, but it is an environment where we should start looking at the watch list again and making a sub list of things that we really want to buy and that we're looking at. So I think that's what we should be doing over the next 2 days, is looking over the watch list more carefully, figuring out which stocks are the most interesting on the watch list at the moment, and maybe consider doing a couple of purchases. And again, because what happened in the last few days, we upped our hedges. We actually came out a little bit ahead on the dip. We feel comfortable that our long-term portfolio is well protected. We have plenty of hedges in the short-term portfolio. Therefore, we feel comfortable buying. We can afford to take risk because we pulled back our risk before the drop. It worked out for us. We're plus $100,000 or so on the dip so far. And we have plenty of cash. So now we put the cash to use by picking maybe 4 or 5 stocks from the watch list that we're going to transfer into our portfolios. And that's what we do on a down cycle. Okay, and we're not going to take a big risk. We're not going to go crazy with anything. But while the VIX is up, that's another important thing, is while the VIX is up, I don't know if we can do that. Yeah. So while the VIX is up at 19, which is huge, well, let's look historically. And what does it mean if the VIX is at 19? It means that we're going to get a lot of money for our premium sales. So, the VIX goes in the channel too. It doesn't, when the VIX is up around 20, it's a great time to sell premium. When the VIX is down here, it's not a good time to sell premium. So while it's up here, this is a good time for us to find positions where we're selling a lot of premium, like that one we just discussed on, what was that? TTD. Okay, I don't love the stock, but I love the premiums on that option sale, and that makes it a worthwhile thing to pursue. And I'm not saying for our portfolio, but I'm saying as far as SK when he was asking before, I'm like, sure, why not? If you have reasons that you feel like you'd like to be in the company and that you want it, the options are compelling. They're so compelling. They're so compelling. I might want to look at the company more closely. But that's what we look at. So that's what the watch list is about. It's about having this list. I remember it's 11:20. Okay, 11:20. So the reason we do the watch list in the first place is that we look at all the stocks, all thousands of stocks, and we screen them and look at them and check them out and whatever, and we pick the ones that we would most be interested in buying and adding to our portfolios. Now, some of these are now in our portfolios already, but whenever we get a dip like this, the first thing we do is let's check out the watch list and see who's still cheap, who's on sale, why are they on sale, and do we think it's still a value at this point going forward? Do they have upcoming catalysts? Have they put their troubles behind them? That's the kind of stuff we're going to be going over in the next couple of days in chat and into next week, I imagine. And especially we're having such a slow move back up. If we don't crash, then there'll be a lot of time to buy and add a lot of these stocks. So, and whenever I'm adding the watch list, you know what happens when I go through the watch list? I always, you know, one stock makes me think of another stock that's similar or in a similar category, so on and so forth. So one thing leads to another, and then I end up like adding more to the watch list. And we take some stuff off too. You know, we decide things are no longer relevant. So I guess we'll do that. And in fact, we may as well do that. Come back on Money Talk on the 25th. So they're gonna want to see a couple of new picks as well for that portfolio. Oh, not this 25th, a month from now, 25th. This 25th is past. So yeah, they just sent me a note saying they want me on the 25th. Alrighty, so actually it'll air the 26th, but it'll be, oh no, I'm sorry. Wait. When they say the 25th, they mean March 25th. And March 25th is a Tuesday, right? That's when they tape. It'll be on the 26th. But anyway, so between now and then, I would like to get a couple of good, exciting stocks to buy anyway, and we'll see what happens. But at the moment, we're just having a generally a weak bounce. So that's there. This is the longer term chart from from the highs of it's the same one, right? 22/19/60. So this is the updated one. So we topped out at 45,000. We fell to 43.5, and that means that a weak bounce would be 43.840. So these have to start turning green before we're anywhere, and we're not even getting we're not even getting there so far. The NYSE has bounced up well, but not not the other indexes, which is kind of weird because the NYSE includes most of these stocks. But we will see what happens. But we're only making very little progress coming back off the lows. We have to get to the weak bounces, have to all turn green. And frankly, if we're not at the strong bounce by Friday, it's a very good chance we're going to go lower next week. So we're not going to rush right into adding watch list stocks, but we are going to start looking them over and making sure and see who still qualifies. All right, so that's my plan for the rest of the week. And I'll see you guys next week, and we'll probably have some more picks lined out, and we'll be a little bit more solid on the list. All right. Thanks everybody for coming, and I'll see you next week.